Your thoughts on the session? At one point we were down about 1.25% and it could have gone anywhere.
A really weak session for the Australian share market, and we saw a number of factors. In fact, the weak commodity prices, the strong US dollar, weak technicals, all combining together. And during our session, we also saw the US futures in negative territory, as well as the Shanghai Composite losing 1.4%. So all up, not a good day for the Australian market. Of course, we have seen the Australian dollar trading at the lows of 2012, and that's been good news for some of the companies making their revenue offshore. So we've seen the likes of News Corporation, as well as ResMed, gaining ground during the session, but investors really looking for the shelter from the storm, and that was the high yielding area or defensives which benefited from that. We saw Telstra, a telecom corporation, doing extremely well today. But on the flip side, the energy and the material sector being sold off quite strongly. In fact, if we have a look outside of the large caps, it was the small miners which faced the most pain. The ASX 20, the blue chip index, was only down by 0.7% today compared to the market which lost 0.9%. But if we have a look at the mid-cap index, that was actually down by 1.6%. And of course, the small ordinaries index got absolutely smashed, down by 2.4% today. So it does look like investors really focusing in on de-risking their portfolios, and that meant getting rid of some of the more risky stocks, and the small ordinaries index really suffering today because of that.
Is that what we're going to continue to see, do you think, Julia? The market suddenly realising actually maybe we need to get a little bit more serious in terms of pricing a potential exit by Greece or a potential default?
James, that's really what the market's focusing in on at the moment, and it is a question of timing because there is a 430 billion euro bond repayment which is due this month, and there's a memorandum of understanding in place with Greece and its lenders that in exchange for this bailout, what it is going to look at is austerity and those 11 billion euros worth of budget cuts which are due by June. So it is a question of timing. It's a time when bond repayments are due, and a time when that agreement with the IMF is due to be reinforced. So the fact that the New Democracy Party wasn't able to put together a majority government, and the second party probably won't be able to as well, means that Greece is probably going to the polls in June. But of course, the market looking for the implications in terms of its bond repayments which are due, and in terms of that memorandum of understanding with the IMF, because while the New Democracy Party and POSAC are supporters of that memorandum of understanding, of course the other parties aren't.
To see this sort of bearish sentiment continue to take hold, if you like, where do you expect to see those areas of strength among equities? Is it the continued sort of domestic defensive plays, the high yielding stocks as we've seen to date?
It will be the high-yielding plays and the defensive areas, the low-beta areas of the market. We've seen that in the past. We'll see that again, that we'll see outperformance from these areas as the market falls and in a risk-off environment. Telstra was a case in point today. We saw a very strong performance by Telstra, moving towards a lot of brokers' targets, and that's really being supported by the free cash flow that the company actually generates, which should support that dividend payment past FY13. So if we have a look at Telstra shares, doing extremely well over the past year. In fact, the stock's up by 25%. When you add in that 14-cent fully franked dividend over the past year as well, it means that the stock's returned about 36% over the last 52 weeks. So that strong outperformance has continued in this risk-off environment, and of course also in an environment where we are seeing those interest rate cuts here in Australia. The budget today really just cementing the fact that we're probably going to see more interest rate cuts, because the budget that came out today really shaving about 0.75% to 1% off.
Dave Rogers from Dow Jones Newswire, and I recommend people, if they can, get a hold of some of his stuff. It's generally very, very good. And continuing with it, Julia, it goes on to say if the S&P ASX 200 bounces off support around 42.50, we could see a reversal in terms of the interest in Telstra as a defensive, and we could actually start to see a little bit of a pull out of it.
Absolutely. If we have a look at Telstra, it's a stock which outperforms in a risk-off environment, a market like last year where the market was down by 14.5%, but underperforms when the market is in a bull market and going up strongly. That's when the high beta areas like the materials and the energy and the industrial sectors really come into favour. And it's so interesting watching Telstra on the charts at the moment. This is Telstra over the last year. It's a fantastic looking chart, but you can see just how those gains have been accelerating over the last few weeks, especially with the interest cut expectations here in Australia also accelerating. If we have a look at the 10-year chart of Telstra, this is what it looks like. And if we have a look at what Dave's pointing out in terms of the Fibonacci levels, if we have a look at the Fibonacci retracement level, and we just have a look at that peak that we saw in 2005, and then join it up to that trough that we saw, and you can see we're right on the level where we are at the moment. So a danger zone for Telstra shares, but the fact is if we get past that level, then it bodes well for Telstra shareholders. We'll probably make a run up to that $4 mark, which is where UBS Bell Potter has their target for the stock, so that's a 12-month target for the stock. But at the moment, a danger zone. If we pass through it, it's a very positive signal for Telstra shareholders.
Look, talking about another stock today, Julia, with some positive momentum, though. Last I saw it, it was around flats. I'm not entirely sure how it ended. Downer EDI, it's had a troublesome time, but reaffirming guidance today.
Downer EDI has had a turbulent couple of years, and it's mostly been around its Reliance Rail project, which it owns 49% of. But it does look like it's business as usual in this contract. It's now got 8 trains on the road, and its 9th train is also due on the 11th of May. So we saw that restructuring of debt for Reliance Rail earlier on in the year. It doesn't look like there's more bad news coming through for Reliance Rail, so that's a positive for the stock. But really, this is a stock that's going to be driven by contract mining, and in that case, I guess the market should be a little bit nervous around demand coming out of the likes of Europe and China, and commodity price is certainly very important there as well. So Downer EDI holding up fairly well, especially in a market that was tumbling.